everyone wants to pick the ultimate bottom, right? But I think you'd be very hard pressed to find someone with a good track record of doing so. But using history as a guide, there are ways that you can spot a turn in the market pretty quickly as a new rally begins. But Justin, how do you go about doing that?
Well, I think first of all, you have to set your expectations properly. And just as you said, look, we don't think that we're going to be calling the bottom. But if we can get close, if we can get within a few days, that's usually good enough. Even if the market comes up 10% off the bottom, there's a lot of room for it to move. And especially if you've sidestepped a good portion of the correction, then you're going to be in a very good place. We always refer to it as kind of keeping your powder dry. Not only do you kind of protect your capital, your physical capital, your money, your portfolio, but you also protect your mental capital. It can be very draining when you're going through a correction and you keep on trying stocks and they're not working. So there is that element too. So, okay, that's once you've done everything right, and you have the expectation that, hey, I'm not going to get the bottom, but you have to start by looking for, in a downtrend, you want to start by looking for a rally day. Now, I say you start because that is not your signal. You can have very powerful days. And a lot of times you see, the media go crazy. Oh my gosh, this was one of the biggest days that we've ever had. I've seen gains on the NASDAQ composite of 14% in a single day. But what you have to notice about some of your top days, if you just take the top 15 gains in the NASDAQ composite on a percentage basis, I'm just going to throw out some dates for you and see if you recognize a pattern. 1987, October 1987, 7% gain. May of 2000, October of 2000, October of 2000, December of 2000, December of 2000. Then you have 3 in 2001, January, and 2 in April. You've got a 2002, October of 2008, and then more recently, March of 2020.
So what do all of those have? What do those have in common?
It was during some very destructive time periods. The 1987 crash, 2000 dot-com bubble, the great financial crisis, and then, of course, the COVID crash. So, yes, you can have some very big days there, but it's surrounded by very, very bad days. So,
you want to put that in context.
One day is not enough. So what we do is we want to see a confirmation of that strength. So that first day of a rally becomes our first day, day one of a rally attempt. And we don't do anything necessarily. We just wait and we watch. And by day 4, what we're looking for is a confirmation of that rally's strength. So what do we look for? The follow-through day has 2 elements. Number 1, we want to see a significant price increase. We want to see power on the day that confirms that the rally is for real. So we might look for like a 1%, 1.25%, or even higher percentage gain for the index. And this could happen on any of the indexes, the major indexes, the NASDAQ composite, the S&P 500. We'll sometimes use the Dow Jones Industrial Average as well. Certainly use that a lot more in the past, but we mostly use the NASDAQ composite and S&P 500. So you've got the price component. The other component, volume. We want to see the volume on that exchange, whether we're looking at the NYSE exchange or the NASDAQ exchange. We want to see it higher than the day before. It doesn't have to be above average, just has to be higher than the day before. That gives us a sense that there's some real buying activity. And, a lot of times that's going to be the institutions, your big mutual funds that are involved. They often control that kind of volume. But as we've seen in the last couple of years, retail investors are having greater and greater power in that regard. But we do want to see that volume there. And just also keep in mind that one of the factors of this follow-through day, it's going to happen on day 4 or later. That's one of our rules.
The rally attempt,
Of the rally attempt. And the rally attempt stays intact as long as you remain above your rally day. And we'll get to some examples in a little bit. If you do close below or actually breach the low of your rally day, that rally has failed and you have to start your count all over again. So in a lot of ways, this is just a very simple counting game, but it can be very powerful. Now, let me throw in another caveat. They don't all work. You will often see, there really aren't any examples where you don't get this signal at a bottom, but the problem is you will sometimes get this signal, it'll roll over and you'll continue lower. So you have to be aware of that. That can happen very frequently. So that's why we do take a measured approach to our entry. We don't want to get completely in. We want to say, okay, let's put a little bit of money to work, and we let the market give us feedback. How does the market give us feedback? You're making money.
Yeah.
Just that simple. And then
Exactly right.
if you're making money, you can, put a little bit more money to work, and that's how you get fully invested. But you don't start, from 0 to 100.
Right. And for those watching the live video version of this, I pulled up a chart of the current NASDAQ, and I was following along a little bit, pointing out that day one of the rally and the follow through day. There's a lot to unpack here just with how this current rally attempt is unfolding. But we do want to take a look at some historical examples of how to get back into the market, Justin.
Yeah, so let's go ahead and start. And I'm going to start with early in my own career. I started working at Investors Business Daily in 1997. I was actually taking phone calls, vacation requests, paper, delivery things, customer service. Started learning about the stock market, and in 1998, about a year into my venture into investing, I was looking at this market that was coming down. And look, there was some negative stuff happening. We had long-term capital management. For those of you that remember when that fund blew up, and Alan Greenspan, who was the Fed chair at the time, was like, hey, we're going to have to bail this out. It's one of those too big to fail things. And so on in this situation, and now, granted, I didn't have a lot of money I was dealing with, a couple $1,000s. And this was back when you had to call up your broker, pay $35 a trade, and, and then they'd call you back later and say, yeah, you got filled. So we had a bottom in September. It was coming down. And then right there at 1475, 49, we had our first day of the rally. On September 8th, we had a follow-through day. I had read the books. I had read the paper. I understood what a follow-through day was. I just put everything to work. Let's go on September 8th. And that day did work for a little while, but then it very quickly rolled over. I learned that I didn't have any sell rules. This was a very important lesson for me. Have your exit strategy ahead of time. I didn't have one at the time. And it rolled over. And then once we undercut that 1475, 49, that rally attempt failed. Now, there were a lot of signs before that things weren't going well, and you would have seen that in your individual stocks. The problem here was my big mistake. We had another rally attempt. You see it come down to 1357.09. You could even consider that day that was down a potential rally, because it did close well in the upper part of its range. So that's kind of what we call a pink rally. So you can consider that maybe day one. Well, as we keep on counting, you go along, and then on October 14th, 98, we got a follow-through day. And this one was very powerful, and it really worked. You can see how well the NASDAQ composite went up. Unfortunately for me, I'm like, oh, you fooled me before in September. I'm not gonna fall for that trick again. And because I was so smart, it wasn't until the market got, well into like almost the 2000 range that I'm like, oh my gosh, this is really for real. I better start buying things. So I was late to the party. Now, Bill, on the other hand, Bill O'Neill, the founder and chairman of Investors Business Daily, who I had the pleasure of working with for about 15 years as his assistant, what he did during this time, he bought one of the stocks that was moving out on that day, a stock by the name of Charles Schwab, ticker symbol SCHW. I think it was SCH at the time. They actually had a ticker symbol change. Now, it's very hard to see on this because this is an arithmetic chart. And so when you have a big gain, the arithmetic chart makes everything before that look very compressed. But thank you, Ali, for switching to the weekly chart here. And you can see, hey, this was a cup with handle. And this broke out on the exact day of the follow-through day. And it went up 400% in just 6 months. Now, hey, look, this was the late 90s. It was a crazy time. And Schwab had something very exciting that they were doing. Rather than calling your broker up, how great would it be if you could just trade online? Schwab was, if you look at what a lot of the brokers looked like at that time, Schwab looked so different. It actually looked more like America Online, an internet company, because of its internet exposure, that it was, moving its trading onto an online platform. So this was a great example of one of Bill's biggest winners that he had. a very great gain in a short period of time, but I missed out. I did get into America Online, but I was late. So maybe I had an 80% gain, which is not bad, but it's not a 400% gain.
Mm-hmm.
And it certainly would have been a lot easier to handle if you had that early entry and were just able to let this run.
Right. Yeah. So the lesson here is, okay, spot the follow through day. They may not all work, but that's why you don't go all in. Have those sell rules. And then if you do see another follow through day, don't miss it. You need to be dipping your toe in the water because it could lead to a huge move in some really great stocks and the overall market.
Absolutely. And I just want to share again, working with Bill for as long as I did, one of the things that I learned very quickly was how he was able to really change his mind as new data came in. And it would almost be like he had a short-term memory. Like he would say something and be very definitive about his interpretation of what the market was doing at that time. But if the market changed, he changed with it. He never planted his flag in the sand and said, well, this was the opinion that I told people. And just as an example, one of the first times that I, started working for him, I'm driving him to the airport in my little Ford Festiva, which is a 3-cylinder tiny car. And he's talking to me about how bearish he is on the market. This was in 1999, so that I started working for him. And he was saying how bearish he was on the market. This was in September, and he thought we had come up so much. Actually, go ahead and show a weekly chart real quick, just to give a sense of how powerful this rally was over years. And he said, you know what? I think we need a more serious correction here. I think we need some time. And I just see a lot of stocks looking like they've topped. So that's what he was saying in September. And he said he sent out letters to 500 clients saying how bearish he was. Well, now fast forward, and we have a follow through day, and he's buying, and those stocks are working, and he keeps on buying, and that ends up being a very powerful rally. The rally into March of 2000 when the Nasdaq topped around 5132 on March 10th. If you missed that rally, if he had planted his flag in the sand and said, well, I told all these clients I'm bearish, I better stick with it, he would have missed that entire thing. So it's very important to, change your mind as the signals come,
Right.
as new evidence comes.
Yeah, I think that's a great reminder for today because there are so many external factors that might make you feel like this or that is going to happen with the market. But if you just try to kind of filter out the noise, of course, you need to be aware of what's going on in the economy, in the market, different industry groups, themes that are unfolding. But let those charts be your guide, because if you just stayed with what your gut was telling you or the opinions of others, like you said, you may miss some really incredible moves in the market.
That is such a good point, Allie. And I can't tell you how many times, if I went with my gut or if I went with my interpretation of the economy, what I would have missed. And just as another example, let's fast forward a little bit and think about after that dot-com bubble, in 2003, what we had this follow through day in March of 2003. And I think it was March 17th, if I remember correctly. And I remember this well because if you looked at the environment at the time, keep in mind, we had just the NASDAQ composite had corrected, the index had corrected 79% from its top in March of 2000 to its bottom in October of 2002. Just a devastating, and a lot of these companies that people were talking about the new economy and how everything is different this time, they didn't exist anymore. I mean, you saw Cisco go from $82 down to like $1. It was just real devastation around the board. Not only that, but when the follow through day happened in March of 2003, you also had a situation where we were about to go to war. We had this madman Saddam Hussein with possible weapons of mass destruction, who was going to blow up all the oil fields, and just a lot of stuff that was really negative about the outlook. But there we were in March of 2003, and we had a follow through day. So if we look at the daily chart here, one of the things that Bill was pointing out at the time was we had these 3 waves down. So if you look in December, there was this wave down to 1327.19, then another wave down, and then one final wave down, and that was the end of it. And there was actually, if you look at some of the volume characteristics here, you did have some volume come in on the upside. So even though we were making new lows, there were still some positive stuff happening. And so then when this March 2003 follow through day happened on the 17th, you also had a lot of stocks setting up. You can't pull up the chart now, but one of them was Yahoo, Yahoo.com, which was a giant at that time in terms of search. You had, some of the defense stocks were actually doing very well at this time. IGT was one that I played, International Game Technology. That's one that you can actually pull up, and it's a good example of a stock. It didn't come out right away. It actually broke out on the day of the follow through day, the 17th, and then it had one more pullback. That was enough to shake me out, by the way. I didn't hold on to it, and then it really moved, and I was out of it by that time. So, but this was just an example. Netflix was coming out at that time. They were still kind of new to the game, but you had a lot of these stocks that, even though there was such destruction in a lot of names, you had these stocks that were setting up and looking like they could move. So, eBay was another one. That one had been already moving since October of 2002. It kind of paused a little bit in February, but was coming out of these bases. So this was another strong one. This was actually my biggest winner that year, and it was already looking good, even though the market had looked so poor for so long.
Yeah. So in addition to looking for those follow through days, looking for the chart setups is something that not only can tell you maybe about the health of the market, but where you need to be looking to put that money to work when you do see conditions improve, instead of just, oh, I like XYZ stock, this is a really great company. Actually analyzing the chart, looking for those proper setups can help increase your odds of success.
Yeah, absolutely. And just as a kind of a point to make there, one of the things we often look at is this relative strength line. This is the blue line on our MarketSmith charts, which compares that particular stock to the S&P 500. It's just a simple ratio of performance. There's nothing proprietary about it. But what it does show you is when a stock is outperforming the S&P 500, and these are the stocks that we like to look for in these market downturns. What's holding up a little bit better? What's kind of resisting the downtrend of the market indexes? And just an example, after the great financial crisis in 2008, in 2009, there were a lot of stocks that were coming up, and a lot of stocks coming off the bottom. I mean, you have Bank of America trading like $1, Ford like at $1. Citigroup had a reverse split just to keep listed on the New York Stock Exchange. So amidst all this, you had a follow through day in March of 09. And this one was tough because a lot of the movement was coming from these very beaten down stocks that were coming off the bottom. And so, yeah, if you have a $3 stock go up to 12, I mean, that's a huge move. Ford, coming up from 1 to like 5, that's a huge move. But you also had a few stocks like Apple and Booking.com. It was called Priceline at that time. And one thing to notice here, let's just do a quick comparison. You see how the index line that you have, S&P 500, you see how the S&P 500 made this new low. It was undercutting the previous lows. But a lot of these stocks, if you look at Apple, if you look at Booking, they made these lows, and then when the market came down, they actually held above their lows. And you see that reflected in the relative strength line as well. It's hard to see the relative strength line in this case because it's kind of getting trampled on by the price. But this is what you could see in a lot of these stocks in 2009, these leaders, that the relative strength was very powerful. And even though there had been a lot of destruction, the ones with the best relative strength lines were some of the ones that led that market, whether it was Apple, Chipotle Mexican Grill, CMG, Booking.com, BKNG. Those were some of your leaders of that cycle.
Yeah. And so seeing that relative strength line at a new high before the stock is hitting a price high is an especially bullish sign. So I could definitely see that with some of these leaders as well, Justin. So a lot of great examples here. What about something a little bit more recent? Let's fast forward to the end of 2018, shall we?
Yeah, and a point that I just wanted to make again, I want to make sure people understand. Look, not all follow through days work. So this will be a good example. And keep in mind, we had a China trade war potentially happening. We had the Fed starting to warn about, hey, quantitative easing. We may have to get back to a rate tightening environment. And as we kind of had this move down, you can see that we had a few follow-through days that didn't end up working. First of all, on November 7th, we had that rally attempt. We had the follow-through day on November 7th, and it just quickly rolled over. Couldn't sustain it, and then you had the undercut. And then it came right back. You had another follow-through day on the 27th, and that rolled over and came right back. Now, one thing that we did have in this case that just to mention, and we won't go into it too much right now, but we can send an article on it that I wrote about vertical violations. We did have this price destruction, just very massive drawdowns through moving average lines, and a lot of times that's a more serious thing that requires some recovery time. So when you see that, sometimes you're going to have to be a little suspicious of your first couple follow-through days, especially if they happen a little bit too quickly. Sometimes you need a few months to kind of let those bases form, let those bases reset to a certain degree. You don't just break your ankle and then hop up the next day and say, I'm ready to run again, put me in, coach.
Right.
You have to take some time and sit on the bench and do your physical therapy. So that's what the market has to do sometimes here too, where it just has to take a break. And look, the third time was the charm in this case. On 1/15, January 15th, 2019, that was the follow-through day that worked. And actually, I think one of the indexes might have had a follow-through day earlier. And you had stocks like Shopify that were setting up at that time, looking ready to go. And that was kind of an indicator that, look, not only do you have the market telling you, but you also have some individual stocks that are setting up at the same time.
That's exactly right. So the vertical violation, we'll put that link in the Q&A if we are able to do that. So another great example of the first follow through day may not always work. We have another example that we want to get to, and that's with the coronavirus crash, Justin, and the 2020 action.
Yeah, here's another example that, look, if you had given me a newspaper that was, from 3 months in the future, if you had given that to me in April and I would, be able to see how devastating a lot of this stuff was, I think I would have just not believed this follow through day, but I had rules, and the rules told me that, look, if you have a follow through day, try and find something to buy. And so after this really devastating COVID crash that we had, and we came down very hard, very quickly, we bounced also just as quickly. And on April 2nd of 2020, we had the S&P 500 follow through, and then the NASDAQ had its follow through day on April 6th. And in this case, you would think that there might have been a lot of stocks that were just, hey, they still needed more time and everything. But what really was surprising to us was that you had a number of stocks that were setting up. Microsoft looked like it was, forming a base at that time and ready to go shortly after that follow through day. Nvidia also, it had come down, but it was back. They were back above their 50-day moving average line. So they were just showing a lot more strength. Nvidia was a little bit more of a traditional, our cup with handle pattern that you can see in the green line, kind of done by our pattern recognition. So that looked ready. Adobe. So there was a lot of merchandise out there. You have to be a little bit more suspicious when you get a follow through day and there's just nothing to buy. It's all stocks coming off the bottom. That's a little bit more what we've been dealing with lately.
Exactly, which leads us to today.
Yeah, so let's go ahead and pull up today, and we can kind of just analyze where are we right now. So we did have a really rough start to the year. I think a lot of people were looking at this as one of the worst starts to the year that we've ever had. And look, there were these signals that we were having before. I mean, if you look at a lot of the stocks, the former leaders like Peloton and Zoom and Square, now it's called Block. A lot of these had been in these major downtrends for a while. Even Kathy Wood's fund, the ARK-K, the ARK fund. I mean, those had been in a major bear market for a long time. A lot of those more speculative names, those growth big winners, phenomenal in 2020. Not so great in 2021, really starting in February. So you already had a lot of these charts showing destructive action, and then the market indexes masked a good deal of that because you had your big heavyweights, the largest companies out there. Remember, these indexes are market weighted, the NASDAQ composite and the S&P 500. And so a lot of the strength that these stocks were showing masked the weakness of the majority of stocks. We had, if you just pull up GMIAB, you can real quickly see how the advanced decline line on the NASDAQ composite was really, again, in a very solid downtrend for months and months before the indexes finally showed it. So, okay, we have the indexes in a downtrend. So what are we looking at recently? Well, as you pointed out at the beginning, we had this great reversal. So that becomes day one of our rally. And then we keep on counting. And so we finally have our follow-through day because we never undercut the lows of that rally. So that rally's intact. But then we have a pretty decent rally, and then we start falling. Now, the problem here was there really was kind of a lack of merchandise to buy. You did have some in the cyclical areas. I mean, we've been talking a lot about shippers and a lot of the oil and gas companies. I mean, energy, that's kind of like what correction. It had a phenomenal start to the year. January 3rd and beyond, it's just straight up for a lot of these stocks. Whether it's XLE or some of the individual stocks. ExxonMobil and Chevron, of course, are two big ones there. But you've got just a lot of the group participating in this move here. Again, a lot of cyclical names that have been doing well. So those were acting well, but a lot of our growth type names have been still underwater, still looking a little bit rough. And those big cap names like Alphabet, the parent of Google, Microsoft, they haven't been showing the strongest action lately. So that's just something to consider about the current market, that there is still a paucity of merchandise out there. Our rally is still intact. And what we saw is what we call some subsequent follow-through days. That kind of adds to the potential rally working, but we're also seeing some distribution days in here. That's where you get selling with volume increasing, like what we saw yesterday. So there's reasons to be cautious right now. It hasn't been an easy environment. And look, if you have just been putting out a few feelers, a few probe buys, again, because we don't plunge, then you're probably not getting too hurt. And that's really the name of the game. When you have such a volatile market, as you and Chris talked about, you want to just make sure you're not making big bets, because that's a easy way to get hurt. It can be, oh, the rally is happening. I got to make sure I don't miss it. And then it rolls over. And then you end up selling at the lows because it's like, oh, this didn't work. And now I have to get out. But then it starts going again. And you can just quickly get chopped up. You might not be losing too much, but you gotta almost die this death of 1,000 cuts. And not only that, but that your mental capital, you just get frustrated. And so when the follow-through day that works finally does happen, or the stocks start moving, then you're so exhausted from all the mistakes that you've made and all the small losses that you've taken. Sometimes you can't take advantage of it.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.